What a week it has been for Boeing after admitting that they are essentially at fault after one of their aircraft suffers a door blowout shortly after the plane takes off in the US. We can also see they find loose bolts on their Boeing 737 planes, which is never a great look. And the CEO essentially had to come out with a statement taking full responsibility and talking about their next steps and how they believe that this should never happen again, as if that wasn't obvious. And now, to make things even worse for Boeing, in today's newspaper we can see a passenger has fallen out from an Air Canada Boeing 77 exit door. So in today's episode, we're going to take a look at Boeing. It is one we haven't reviewed before on the channel. As always, we're going to do our deep dive analysis, coming to the conclusion on the valuation, whether or not we see the intrinsic value making the company look undervalued, getting to our acceptable buy given our margin of safety, and finding out what Wall Street expects from this price over the next 12 months. We'll be running through their income statement, looking at their top line revenue, bottom line net income growth. We're going to be taking a look at their balance sheet total cash versus their total debt. We'll also see how well they've performed versus some of their competitors over the longer term. We'll analyze the institutions, whether they've been buying or selling this company. We'll even take a very quick look at insiders to see how they have been performing. And as always, we will look at the financial metrics around Boeing Company, which is essentially in the aerospace and defense industry. So let's take a look at this company now. Over the last week, we can see it has dropped 8%, although it has started to slightly recover from the initial drop at the beginning of the week. Now, over the last year, we can see this company is up around 10.23%, so it hasn't been the worst performance for 2023. They did lag behind the S&P 500, and over the last 10 years, we can see, whilst it has been up 64%, it doesn't include those dividends. We can see its all-time high was essentially before that COVID drop at around $440. And yes, they don't currently pay a dividend, but they had before, and we'll discuss more of that shortly. In terms of the 52-week range, they sit pretty much in the middle, and currently the earnings per share forward is negative 6.21. Again, we will discuss this later on the channel. So in terms of the income statement, what we typically look for, 3 to 7% growth year on year to the top line. And we can see December 2018, 101 billion reported on the top line. December 2022, 66.6 billion. So what we can see, in fact, their top line revenues have been reducing. We can see from 2018 to 2020, in fact, it was going downhill before picking up in 2021 and 2022. And it is positive to note that whilst we haven't received the annual report for 2023, they are expecting an increase to their 2022 top line figure, which is positive, so they have started to increase that top line. So when we analyze the bottom line net income to see what story we can see, 10.5 billion of net income in December 2018, December 2022, in fact, 5 billion loss. And when we take a look out of the last 5 years, 4 of those years they have made a net loss. 2023 is expected to be similar with a loss of around 2.8 billion. So let's keep going and seeing if we can find some value within this company. Total cash then versus total debt, a quick health check of Boeing. 8.5 billion of cash and equivalents and short-term investments in 2018. Latest quarterly report, 13.4 billion. So they are holding more cash, essentially slightly more than 50% increase over the last 5 years. But it's important to compare that numerically and directionally to their total debt to get a quick sense of their health. 13.8 billion in 2018, 52.2 billion from their latest quarterly report. So yes, their cash has increased 50% to around 13 billion. But when you take a look at that total debt, it has increased even more than 50% and is sitting significantly higher than their total cash amount. Now, that doesn't necessarily mean that's a red flag indicator, but something to bear in mind, and we'll look at some of those financial metrics that do support whether or not this company is healthy. So let's take a look at some of these companies in the aerospace and defense industry. We have Airbus, RTX Corporation, Lockheed Martin, and a few others, of which we have reviewed the majority on the channel. So if you are interested, do go and take a look. So over the last year, we see Boeing up 10%. In fact, they are one of the middle performance of their peers, and we can see not every single company over the last year did bring a positive return. We have RTX, in fact, with a negative 11.6 and NOC with a negative 3.25. So let's take that over the last 5 years. So Boeing over the last 5-year period is down negative 34%. In fact, the worst performing. Something to consider, but as we always say, past performance is never an indicator for future performance, but it is always good to add as one level of your review. Now, institutional ownership sits at 61%. We can see around 5.2 billion worth of outflow sales by these institutions over the 12-month period, although over the same period we do see in fact more than double buying, so institutions are buying more shares of Boeing than they are selling. Although do note in the latest full quarter Q3 there was slightly more selling than buying, but very marginal, with the 3 quarters before that significant buying than selling. Again, whether Wall Street or the institutions are buying or selling should never be a consideration. Always do your own due diligence, but it is always positive to see whether or not institutions are buying or selling stocks that you're looking into. Now, one thing we can take a very quick look at is insider trading, whether they are buying or selling. We can see over across the last few years there hasn't been much movement. The latest movement, though, we do see is around 2 million selling. And when we do take a look, we can see this was the CEO. Sold around 8,500 shares at around 2 million in total. Now, this isn't necessarily a bearish signal, but again, just something to consider. So let's take a look at some of the financial metrics for Boeing. Now, market cap 138 billion. It is a mega cap company. Now, as we mentioned earlier, they did pay dividends before, and what we can see from this graph, they in fact stopped in 2021, so it wasn't that long ago. They were increasing it for some time. In 2019, though, when the pandemic hit, they did start to cut, and they had 2 back-to-back cuts, and therefore, right now, Boeing do not pay a dividend. So let's take a very quick look now. Obviously, they don't pay a dividend, but before when they did, we can see that free cash flow payout was looking fairly healthy, below 40%. So it remains to be seen whether or not they will reinstate those dividends. Free cash flow per share then at 781, and just one thing to mention, we typically do focus on the free cash flow metrics for those that are new to the channel. Earnings metrics are susceptible to manipulation by management through accounting, and on previous episodes we have gone into a deep dive as to why. 781 then, free cash flow per share in 2013. We can see now in 2022, 385. But do note they had 3 years of negative free cash flow per share. And we can see when we did review those income statements that they did have a few years of a bad period, especially on the top line where it did drop, as well as the net income, essentially a net loss for quite some years. But the positive is to note that 2013, 2018, they did have some good growth. And 2022, whilst at 385, and whilst we have the 3 years of negative free cash flow per share, 2023 is expected to be positive. 2024, again, they are expecting this to increase. So it could be positive turnaround play, but always there is more information that is needed before we look into these stocks to buy. Sales growth then, as always, 3 to 7% year on year, and we can see a very inconsistent. That COVID pandemic dropped back-to-back years of negative 24%. Now, 21, 22, 7%, which is at the upper end of the minimum we really look for, so that is positive. But what is also strong to see is that in 2023, they are expecting, when the annual report is released, 23% growth to the top line. Don't forget as well, hit that bell and subscribe button so you are notified, as we will run through the earnings when it is released. Now, in terms of total sales, whilst we did run through this, we can look essentially at the last 10 years numerically. So 87 billion in 2013, 67 in 2022. So yes, it has been decreasing, but do note it is picking back up in 2023. Shares outstanding, we love it as investors when companies do share buybacks, returning excess cash to our pockets. 770 million outstanding in 2013, 595 in 2022. So the net position over the period has been share buybacks, but we can see some years, in fact, from 2019, where they were struggling, where they did cut that dividend back-to-back years, where it is now nil. We can see they have started to then dilute a shareholder's position by increasing those shares outstanding. But over the last 10-year period that we're looking, the net position are share buybacks. ROIC then, as always, what we look for is 10% or more. It shows us that management are able to effectively allocate their capital. Now, 2013 to 2018, that pre-pandemic, we did see quite strong metrics across the company. However, 2019 to 2022, this hasn't been great at all. But again, 2023 is showing some promise. It is turning into a positive, and this could be one to keep an eye on if they manage to turn this business around from the poor performance of the last few years. And this can be shown by the fact the operating margin for that post-pandemic level is in the negative, as well as the free cash flow margin. But as always, something to keep an eye on if companies are trading at a discount, even if they don't look to be the greatest business. If you can see value over the future, then that is where you can find some gems. Now, net debt to EBITDA, earnings before interest, tax, depreciation, amortization, typically shows us two things. One, the dividend safety, which unfortunately they don't pay, and secondly, the balance sheet strength. Now, 2023 is expected to be 48.18, which is incredibly high. We're looking for around 3 or less for the typical companies. 2024, they are expecting to bring this down significantly, so something just to keep in mind. We are looking for around 3 or lower, and we did note when we were looking at that balance sheet, the health, it was very high, their total debt increase in comparison to their cash, so something just to consider here. So let's jump into the valuation now, and as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And don't forget, you can click on that pinned comment below to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies, not only in your own portfolio but also those on your watch list. So we will jump into all 4 formulas. However, one thing to note for Graham's valuation, it is based off the earnings per share. Now, the 2023 earnings per share, it shouldn't come as a surprise, is negative, and therefore, whilst we have used the expected 2024, this isn't going to be the most accurate, so we won't include it in the final version. But what we can say is the earnings per share plus the long-term growth rate plus the current yield on AAA corporate bonds would give an intrinsic value near enough the current market value, but we do see a sign of overvaluation due to the intrinsic value lower than that market value. The second one, again, would typically be the multiples valuation model with companies in a similar sector and size. But again, as this is based off the earnings per share of Boeing, what we mentioned in the previous model still applies, so we won't be using it. And as we can see here, we would have a sign of overvaluation. Now, they don't currently pay a dividend. They did in the past. In fact, it was only a few years ago, so this one will not be used. So the real model we're using to value Boeing stock will be the DCF, discounted cash flow model. We have the free cash flows year on year. Average growth rate, we've pretty much gone for the growth rate forward, looking at pretty much in line with the average. With that discount rate, we get the present value of these future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. We get an intrinsic value of $265, showing our sign of undervaluation. Now, when we get into the intrinsic value, typically it is the average of the models that we use. However, as mentioned for Boeing in today's episode, it's purely the discounted cash flow model valuation. So the current price at $227. Now, the way we work this, regular viewers know, we start off with 10% if we believe it has a wide moat, strong financial metrics, and good forward-looking data. So at 10%, it is essentially showing a buy up to 239. At 15%, around 225. So not too far off, $1 or $2 shy of the current trading price. So for Boeing right now, the margin of safety is showing around 15%. In terms of what Wall Street expect, well, they believe the share price to go up even higher than our intrinsic value to $280. So they see just over 20% upside to the current trading value. So in conclusion, for Boeing stock, whilst we see around 15% margin of safety based on our estimates and judgments, Wall Street see around 22% upside. As always though, let me know your thoughts on this company. Is Boeing one that you're looking to add to your portfolio? Do you already hold even companies within this industry? Or is it a company that you aren't going to touch? Now, personally, for me, this isn't one that I'm going to be adding. I don't know too much about this company, about the industry, and we have seen a lot of negative news. Personally, though, I will take some time just to read up more and see whether or not this is one to be interested in the future. But right now, personally, based on the metrics that we did run through, it isn't one I will be looking to add. However, if we see in the future that those metrics do start to turn more positive, the free cash flow per share, the return on invested capital, figures and percentages, the net debt to EBITDA, then it may be one for me to consider. But let me know your thoughts as always below. As always, have a great day. Catch you on the next episode. Don't forget to click on that pinned comment below. Grab yourself a valuation model. Get to the intrinsic value and acceptable buy price of companies in your own portfolio and watch this. Have a great day and catch you on the next one.